Good afternoon, everyone. Let me introduce all those who are on dais. I'm Ashutosh, Khajuria. I take care of the departments in my team are, you have the 4 stages of credit delivery, sourcing. Since morning, we have been meeting the sourcing team guys, whether, led by the branch channel or through relationship managers. And then the second stage is, of course, the underwriting. Underwriting. Third, of course, the administration and monitoring, and then collection and recovery. Barring sourcing, the remaining 3 are part of my team. We have with us here the underwriters, because for a good credit quality that you have been seeing, pristine one all through, running through the challenges of COVID, pandemic and all, right from Kerala floods in 2018, and then repeat of that in 2019, then followed by, COVID and all. In any of the quarters, banks' GNP has not crossed 3.5%. So I think there would be very few banks probably who would not have had the bottom line also not going into red in any of the quarters. So I think the 4 stages I was talking about, of course, sourcing has to be good, selection has to be good, but then there has to be a very sound underwriting as well. So we have our corporate underwriting head here and the national credit head, credit hub head, Mr. Diwakar Dikshit and Mr. Sanjesh Kumar. Diwakar, are you there? Please. So Diwakar takes care of the commercial banking to business banking to centralized retail credit hubs and even large value agricultural proposals, whereas the corporate ones come under Sanjesh Kumar. So it's a good underwriting, sound underwriting that also helps in containing the credit risk. Then of course very good collection and recovery. Overall, bank slippages have been. And now we have moved to that stage that they are less than 1% of our advances book. And of that, almost 2/3 is recovered through, cash recovery and upgradation. The remaining one, this I'm saying excluding the write-off part or sale to ARC or any such thing. So this through cash recovery and upgradation alone, 2/3 of that is recovered. And that's one reason why the credit cost has been quite low. Now, I'll just move from credit risk to market risk. And I have with me on my right-hand side, Mr. Lakshmanan, who is the treasurer of the bank with about 25 years of vintage with one of the MNC banks, and then with us for last more than 4 years. And then on my left is our ESG initiative head, Mr. Ajit Kumar A, looks after a journey which bank had started about 3-4 years back. Prior to that also, there had been lots of ESG related initiatives taken, but they were mainly through the CSR route and all. In 2018, there was a big discovery that we found, I think in Kerala floods, one in a century. Once again, a black swan event. Our guys, our teammates, voluntarily put their lives to risk and rescued, and they just participated in all those efforts that were there to, to reduce the pain, if I may use that term. And then when we thought, why not make it more structured and all, and should not just remain only the CSR, some sort of statutory obligation or so, and we should move in this direction. And in the process, when we started this journey, we partnered with the IFC, who for the first time in Asia, they claim, they infused equity in any bank. So they took about 5% stake in Federal Bank. We got about 916 crores of equity way back in July of 21. So this is the backdrop in which, now I'll pass it on to Lakshmanan about, how the market risk was contained, because this particular year is very relevant, wherein, we have seen because of the policy rate hike, to the extent of 250 basis points. I'll call it, rather than 250, it's a 315 basis points hike, because the overnight was ruling somewhere closer to reverse repo, which was 3.35%. And from there, now the market has moved to closer to repo rate, overnight bank rate. So actually, we have moved from 3.35 to 6.5. So it's not only 250 basis points move up, but actually 315 basis points move up. Because of surplus liquidity, market was quoting at, closer to the floor, and which at that time was reverse repo, and now it's because of the deployment and, more demand for funds or so, it's now quoting closer to repo. So in this particular background, how to manage market risk, and our bank being one of those few who were not required to have a very high mark-to-market, provisioning requirement or so. So I think let that be, shared with you by Lakshmanan.
Thank you so much. And I think an additional thanks to add on those 2-3 years more of experience than the 20 odd years that I've had. Perhaps I've graded a bit more, overnight. So getting into the residuals, which is what is treasuries in a certain manner, I'll quickly talk about, the philosophy that drives the activity of treasury within the bank, and that's essentially the risk-return balance, which is that circle on the top left. We'll take a minute of explanation of that. One, you might have noticed the market risk consumption of the capital that we do, which is, I would say, fairly paltry. To that extent, one, with a limited market risk consumption that we have, how do we deliver profits, how do we deliver returns effectively then becomes a key thing that we look into. And to that extent, volume becomes a significant play, and a huge amount of focus that we have in terms of the way we cast our activities to see what more can we do within this risk sphere. So more volumes in customer business, more trading, etc., within this limited risk space is what is a focus. Comes in technology to deliver that. That's a significant focus for us over the recent years, and you would see a lot more of it coming in, delivering more value, bringing in efficiency into the activity we do. Learning, very significant for us. Of course, one would argue that it's a part of any organization and its life cycle. But for us, I think, I'll perhaps give a small example. For every working Saturday that we have, there is a certain topical presentation that is picked up, and more than 100 people within the bank from different departments, treasury, the back offices, the credit department, etc., are a part of it. I think the great thing about those sessions that we have, right, in the last about 2 years, what I can claim is within the treasury unit, more than 50% of my team have actually engaged in presenting some session or the other. It could be crypto, it could be CBDC, it could be Sri Lanka, it could be Turkey, it could be any development that is happening. And all of it seeps into the products that we do, into the risk measurement that we are looking into, and in a certain manner driving in the wheel that is there. And more the faster the wheel moves, we believe we are looking at a higher revenue offtake. How has this particular wheel delivered for us in the recent years are the 2-3 charts that you see. The bottom right graph, which is the Forex number, very clearly the chart is looking up. So what we are saying essentially is that the Forex profits for us have been moving up. Again, the merchant activity, the trading activity, the derivatives business, all of them have been consciously thought through, and we are looking at those numbers moving up and significantly contributing. A small point that I would mention, when we compare ourselves to the peers, we are pretty much there. The chart on the top right pretty much says that we are not far away, but we would want to state, if we are looking at upside in terms of fee income, That's one place where we think we will be doing a lot more in the years to come. Coming to the bottom left, which is the profit from sale of investments, very clearly we stand way above the rest. I think Ashutosh just mentioned about the risk management dimension over there. I think the way we would say it is, the book management for us, in terms of the way we manage the duration on interest rate cycles, ensures that when rates come lower, we are able to encash on the value very superbly. And at the same time, nimble enough to manage the duration and lower it when rates move higher. If you look into the Q3 FY23 number, it's a small profit that we are showing over there. But I think all I'll leave with you is, while you've seen those numbers for us, I'm sure you would have seen the numbers for some of our peers in the same quarters, and they might not have been exactly in positive. So in summary, both spheres you're doing quite well, and lots more to go, specifically on the Forex part. Again, talking a bit more about the risk return wheel, how it has played out. One, more clients for us in the recent years, driving in more volumes. If you see the volume charts moving higher, the trading activity, which are the two charts in the middle, has been again significantly going higher. At the same time, again, all along, our market risk consumption still pretty much remains not much impacted. Going further lower, if you look into the spot volumes that we are having, we are about 4.5% kind of volumes of the market that we are trading in. We are about 1 to 1.5% of the overall balance sheet size of the industry, but we are actually contributing about 4% of the market volume. Now, what are we trying to do over here? Again, operate in the market in a certain manner, which is risk balanced, but again, delivering in the return we are looking into. Same on the exchange business for us. New products have significantly contributed to the incremental value that we have delivered. So the value coming out of new activity for us in the recent years has moved up. Derivatives are contributing more to us. Hedging activity is contributing more to us, supported by technology. The Fedi Connect, which effectively is the platform that we give it to our exchange house counterparties, are transacting more through us, which means we are spending less human time in terms of processing it or giving in prices. And Fedi Connect is going to be all pervasive in terms of our pricing from exchange houses and then to our other merchant customers as we move along. Many more. I've just put in a few of them: algo trading, retailizing of treasury products, new segments of customers, and maybe I'll just talk a bit about our presence in gift. We've been there in terms of the basic activity like buyer's credit, trade, syndication, loans to our Indian corporates overseas over the last 5 years. Ever since IFSC regulator has come by, we are looking at using gift as an ability to draw in retail customers, do more business with them, our NRI customers, acting as a investment into India conduit through gift, for example, AIFs and entities like that. So all those conversations are happening right now. Of course, we all recognize that there's lots more to happen on the gift space. It's still evolving. But I think we are positioned ourselves very well to ensure that we use that to our advantage as and when more products are happening. Last but not the least, we've been recognized for the performances in terms of our activities. NSE, BSE have recognized for our volume that we contribute. And we are significantly present in the shaping of the market. We are members of FEDI, FAI managing committees. I sit in the board of FIMDA, effectively shaping in how the markets are developing right now. So in summary, in good position is what we believe, and hope to do more. Thank you so much.
So thank you, Lakshman. I think I just shared with you that because of our, starting a journey towards ESG, IFC was interested in investing in us, and they are also helping us in having and also sharing with us the information about how the banking industry is doing overseas as well because of their reach and all, and advising us on certain aspects as to how we can move forward in that direction. You would have heard Harsh and Kapil committing here, telling that they would be building up a $2 billion green book. I think very recently we were given a certificate of appreciation by IFC on having completed the $333 million equivalent of the climate book, which in IFC's, amongst the IFC's partners also was the highest in Asia. So this is one part, and I think this bank had already been in this journey, and some of it, like your, one of those 17 sustainable, goals, sustainable development goals. One is gender diversity. Bank has 43% of its staff as females. So that had been built over a period of time. It's not that suddenly we have joined this journey 4 years back and then suddenly the recruitment patterns changed or so. You need to have 1/3 of your directors on board as independent directors. We have more than 2/3 of our board of directors as independent directors. Statute wants one woman director on the board. We have 2. So like that, I think there were so many things which bank was doing, as a part of its commitment to the society and all. But now it has become more structured. Listing all these things, disclosing it in your annual report. All that BRSR thing was to be made mandatory for this year, that is FY23, and it was optional for FY22. We, opted that, and we did that in FY22 itself, all those disclosures and all. Now, but to hear more on that, I would request our ESG desk head, Mr. Ajit Kumare, to share his thoughts.
Good afternoon, everyone. Thank you, Ashutosh. So ESG is the new normal and really becoming a buzzword amongst all the stakeholders. For us, while the word ESG is in recent addition, the work is decades old. We have already listened from the previous presenters how passionate we are on inclusive finance and how priority sector advances is seen as a business opportunity rather than directed lending. Of course, there is an added focus on green finance, as already mentioned, in addition to the other sectors of ESG. Again, as already discussed, while most other organizations across the globe is committing for a gender diversity with female employee share of 30%, we are well above 40%. Our attrition rate is one amongst the lowest, below 3%. You would agree that all these could not be achieved overnight. All these were the culmination of cumulative efforts over many years. Again, there comes the Rishta Aapse. We care for the society. We care for the people. We care for the customers. And we have chosen cares as our core values. Trustworthiness, compliance, and governance are the 3 basic pillars on how we operate. All these activities, as mentioned earlier, has resulted in a global marquee investor, IFC, choosing us to invest their first green equity in Asia. Again, we are also being recognized by Great Place to Work in. I have to mention that GPTW India, we were recognized thrice consecutively. We have been recognized by GPTW Asia the last time. And most importantly, we are recognized by GPTW for women for the 2 consecutive years, and we are waiting for the 3rd one. Now you can see our strategies and commitments to our customers, employees, community, and organization as a whole. As explained earlier, these activities were integrated into us not by chance, but a conscious choice that we have made. One additional area where we are working now is to contain our own GHG emissions. We are working on with various initiatives to reduce our emissions through opening of green branches, by enhancing our own installed solar capacity, our water conservation facility, etc. We have also committed ourselves to a non-coal policy where we have committed to the world that we will be phasing out coal completely by 2030 and becoming future ready in our credit risk through a robust environmental and social management framework. Our employees are our core strength and will remain so forever. And our CSR goals are all aligned to the UN Sustainable Development Goals, and we have already heard from Mohan sir speaking about the Miyawaki forest. We are again working on the Hill of Flowers. All such activities are happening from our side to prevent the planet also. Here we are again elaborating what we have already seen. We take all efforts and leverage the business opportunity on moving to a low carbon economy and tap the business opportunity of Bharat. While inclusive financial inclusion helps the underserved people of the society, we also have come up with the commitments on green finance. And as already mentioned, we have been awarded by IFC for disbursing the largest climate loan in South Asia region. We have also rolled out an ESMS framework, which is put in the public domain also to ensure that the future credit risks due to unavoidable transition to a low-carbon economy are properly managed through a host of activities like environmental and social due diligence, corrective action plans by the borrowers, sectoral policies, climate risk appetite, etc. And this is how we create a positive impact on our environment, employee, society through our actions. As already mentioned, our CSR activities are also focused on supporting education, providing healthcare, youth empowerment, and environment upgradation. We are committed to wholesale wellness of our employees, and our digital initiatives further reduce the environment emissions, carbon emissions, while giving banking at the fingertip of our customers. We are proud to have a diverse and excellent board of directors who set the tone at the top. Our sustainability score across the rating agencies have improved significantly, and we are well above the industry average, both nationally as well as internationally. So that's all from me, sir.